You know, when it comes to the stock market, they say history always has a lesson for us, right? But the real question is, are we actually listening? Because there's this old cautionary tale, a story from the past, that sounds an awful lot like what's happening today, and it's one that almost nobody talks about anymore. So let's dig into this forgotten chapter of Wall Street.
The legendary investor Sir John Templeton, this is a guy who averaged 15% annual growth for almost 4 decades. He knew a thing or two about market psychology, and he understood that believing this time it's different is probably the most expensive mistake an investor can make. It's just a powerful reminder that our own conviction, our own belief that the old rules don't apply anymore can be our worst enemy.
Okay, so when I say market bubble, what's the first thing that pops into your head? For most people, it's the dot-com crash in 2000, or maybe the 2008 financial crisis. But we're going to talk about a different story, a forgotten piece of Wall Street history.
And here's the kicker. What if this forgotten bubble, this whole cautionary tale from 50 years ago, what if it isn't just history? What if it's kind of a roadmap for what could be happening right now? That's the question we're going to explore.
All right, let's set the scene. We are talking about the Nifty 50 bubble from the early 1970s. It was this incredible period of wild optimism that, well, ended in absolute financial carnage.
When this bubble finally popped, the damage was just breathtaking. The market plunged by half, 50%, between 1973 and 1974. And to put that into perspective for you, at that time, it was the single worst bear market the U.S. had seen since the Great Depression. A complete and total collapse.
And the aftermath was just brutal. The biggest, most respected companies in the world saw their values just evaporate. Inflation shot through the roof. Unemployment basically doubled. And this wasn't some quick little dip in recovery. Nope. It took 8 long, painful years for the market just to crawl back to where it started.
So you have to ask, right? How did Wall Street walk straight into this buzzsaw? Well, to understand the crash, you first have to understand the incredible, almost blind optimism that came right before it. So let's rewind a few years to the late 1960s.
After World War II, America was basically on a 20-year economic sugar high. People had jobs, they had money, and there was this feeling that the country was just invincible. And of course, that feeling spilled right over into the stock market, which had been on this incredible tear for over 2 decades. In this environment, it gave birth to a very popular and very dangerous investment idea.
They called it investing in one-decision stocks. And the concept was, well, dangerously simple. The idea was you find these companies that are so powerful, so dominant, that you only have to make one decision ever to buy them. The thought of ever selling them was considered just crazy. And who were these stocks? Oh, they were the titans of their day. The big household names we now call the Nifty 50. We're talking about rock-solid, blue-chip companies like Coca-Cola, McDonald's, Xerox, and Polaroid. Investors looked at them and thought they were absolutely bulletproof. But you know, here's the thing about investing. Whenever something sounds like a total no-brainer with zero downside, it's often a financial grenade with the pin already pulled. And that whole never-sell mentality, it pushed the valuations of these stocks into the stratosphere.
Now this slide, this really shows you the disconnect from reality. So a PE ratio, price to earnings, it's just a simple way to see if a stock is cheap or expensive. As you can see, the average PE for the whole market was a pretty sensible 15. But then look at the Nifty 50. Their average was 42. They weren't just expensive, they were being priced as if gravity simply didn't exist.
And the concentration was just as staggering. Look at this chart. At their absolute peak, these 50 companies made up roughly 45% of the entire U.S. stock market. Just think about that. Nearly half the market's value is tied up in this one single, wildly overpriced idea.
And then the dominoes started to fall. In 1973, oil prices went crazy and inflation just exploded. Reality came knocking, and it knocked the door down. The stock market went into a complete freefall, and it took that whole Nifty 50 dream down with it.
And this fallout, it just shows you how vulnerable those bulletproof stocks really were. When the economy turns, stocks that are priced for perfection don't just correct, they get obliterated. Coca-Cola, down over 60%. McDonald's, down over 70%. And Polaroid, once a darling of Wall Street, collapsed by more than 90%. The one-decision stocks became one massive cautionary tale.
So, why does this 50-year-old story matter today? Well, if you're looking at the market right now and you're getting this little sense of déjà vu, you are not alone.
Mark Twain said it best, right? And while today's market is not identical to 1972,
You really can't deny that it rhymes. The patterns, the feeling in the air, the concentration, it is all eerily familiar.
I mean, the parallel is just striking. The Nifty 50 were seen as these invincible pillars of the old economy. Today, we have the Magnificent Seven, our big tech giants, and they're seen as the invincible drivers of the new global economy. It's the same plot, just, with different actors.
And here's where the data really gets your attention. Look at this slide. Back in '72, 50 stocks made up about 45% of the market. Today, just 7 companies account for around 36% of the S&P 500. 7! The concentration is just incredible, and it feels very, very familiar.
And what about the valuations? Well, it's just like the Nifty 50 all over again. Today's market leaders are priced as if nothing could ever go wrong. We're seeing PE ratios of 37 for Apple, 50 for Nvidia, and an absolutely astronomical 247 for Tesla. Are these amazing companies? Absolutely. But are they being treated like they're bulletproof? Also yes.
Which, of course, brings us full circle. We are once again looking at a super top-heavy market, kind of pretending that valuations don't really matter, and telling ourselves the same old story. These companies, they're untouchable. They'll just grow forever.
And maybe Warren Buffett summed it all up best. The reason these patterns keep rhyming, it isn't about economics. It's about human psychology. It's about optimism and fear and that deep desire to believe in a sure thing. That stuff, that never really changes.
So the story of the Nifty 50 leaves us with a really critical question. It's the same one that history begs us to ask in moments just like this one. As we look at today's market, with its incredible concentration and sky-high valuations, are we quietly whispering those 4 most expensive words to ourselves again? This time it's different?